Welcome back. This is part two of our episode on Saturday evening, May 2nd, 2020. We're talking about the opportunity to deal with the economic crisis as a result of the spread of the COVID-19 virus. In the first half, we talked a bit about consumption and the hole in consumption and typically the kinds of things that we do to deal with a fiscal emergency like that, and the sort of the concern that we have now about harm to our productive capacity as a result of the shutdown of large parts of our service sector. But there's also a decline in investment, which we expect to see continue through the second quarter. Investment, from the formula for GDP, refers to things such as residential housing, commercial construction, industrial plant equipment from the commercial sector, including computers and software. Typically, we look to boost that portion of GDP by monetary policy. And monetary policy are those actions we talked about a few episodes back, undertaken by the Federal Reserve Board and its Open Market Committee, typically to lower interest rates in an era of this type. So the Federal Reserve's fundamental tool is to lower interest rates by setting a target and then conducting monetary policy to meet that target for very short-term interest rates. So we call it the federal funds rate, which is technically the rate of interest that one bank lends to another bank for an overnight loan. And these loans would wind up being done to help banks, for instance, meet their reserve requirements because they may have been slightly off in their calculations. So that's the fundamental use of that, but it acts as a gauge for other interest rates. Monetary policy traditionally has less impact on longer term rates, like a 10-year rate, but interest rates do move in concert with one another, meaning that typically when the Federal Reserve lowers short-term rates, the longer-term rates will also decline by a proportional amount. So the Federal Reserve lowers these interest rates in order to spark construction. If you think about it, if you have a business project that you're trying to justify, you're justifying it based on its internal rate of return or some other kind of business metric. And if you have lower interest rates, the overall investment cost for the particular action would be lower. And therefore, businesses would likely engage in sort of more of this kind of activity, meaning that it's less expensive for them to build a new office building or build a new factory or buy equipment to put in it, all of which typically have to be financed because they're not paid for out of cash. And residential housing responds to this cue as well, because residential housing market is very sensitive to mortgage rates, and when the Fed lowers interest rates, typically mortgage rates go down. So, for instance, the Federal Reserve has aggressively acted in this crisis to bring down the already low interest rates down to zero in the United States, and we've even seen official negative interest rates in Europe, as announced by the European Central Bank, which it acts basically as the same kind of thing as the Federal Reserve does, but for the European countries. The other critical component of investment are folks' expectations for the future. If people think that business is going to expand, over time, then they're going to be willing to make the investment to expand their productive capacity. If they think, however, that business will be tough, that times will be tough, the economy will be sluggish or declining in this case, they're going to cut back on those plans to expand, and we'll see further decline in investment as a result of that. So, in the past, for instance, a familiar tool that was used is some version of an investment tax credit. This is a tool that's been used off and on for many decades now. But in the last crisis in 2008, 2009, there were accelerated depreciation tools, the capability of writing off equipment purchases in 1 year, which saves current cash when you're looking to make this kind of investment. So again, it's a way of providing an incentive for firms to to invest money. Now, currently, the Federal Reserve is taking extraordinary action. The federal government is taking extraordinary action to help subsidize payrolls, to try to get folks to cut back on layoffs. It's not entirely clear how well it's going to work because of the way it's being done and the lateness in which that program is being launched. And there's also another program that the Federal Reserve is trying to put together to provide loans of working capital to firms to try to help them keep afloat during this period of time. The Federal Reserve does not think that it can take on risky investments that could lead to defaults. So the federal government, as part of the CARES Act, put forward some capital to help cover anticipated losses in the Federal Reserve's loan program, and they're working out the details to enable that to move ahead. In the meantime, the Payroll Protection Act has gone forward, which provides these other kinds of loans to businesses, which, if used overwhelmingly to preserve their payroll, as well as to pay any lease costs that they have, property rental costs that they have, it could eventually be forgiven. In either case, these are like zero interest loans that are being given over a period of time. The fundamental issue is, however, that if you're in a service industry where you're getting next to no revenue, how long can you continue to do that before you say, well, we're going to need to bankrupt the business and move ahead because I need to generate some additional income and try again at some point in the future. This is a very real concern given the shape of the economy right now. Now, another portion of GDP we talked about was the component related to international trade. We saw in those GDP statistics that in the United States, exports declined significantly, but imports declined at an even greater rate. So international trade is being hurt at the same time as the rest of the economy is suffering. Typically, exports are viewed, and it doesn't matter whose exports, anyone's exports are viewed as a function of prosperity abroad, meaning that the more money that folks around the world have to spend, the higher will be our rate of exports. I mentioned before in previous episodes that there are certain economies that are very well tuned to be driven by exports. The two most famous ones are China and Germany. They're the two biggest exporting countries. Exports are a significant factor for the U.S. economy. It's just that they're significantly lower than our imports are. And imports, as we've seen quite clearly, both in the last crisis and this one, are a function of consumption and income at home. So when consumption declines, income declines, there's going to be a reduction in imports, and both are lagging now. The problem here is that our usual tools for dealing with this, things such as subsidies, oh, okay, I'm going to subsidize you in order to enable you to export. The United States, our single biggest exporter, is Boeing Aircraft Company. They have all kinds of problems right now because of product concerns, but also because their customers are shutting down. So it doesn't matter how much of a subsidy we gave to Boeing right now. It's not really going to help a great deal if international airlines are closing down operations. But we've signed also a bunch of trade agreements where, and our membership in the World Trade Organization, where we basically have promised not to do those kinds of subsidies anyway. And we're fighting with other countries that do. Then the other thing you typically do is currency depreciation. If our currency is reduced in value versus, say, the Chinese currency, then our products and services become less expensive for them to buy. Their products and services become more expensive for us to buy. So our imports should go down and our exports should increase as a result of currency depreciation. But the thing is, we can't really do that right now because the US dollar is a reserve currency for the world. There are so many other economies that depend on the value of the US dollar. And the technical way that you can depreciate your currency is to cut interest rates relative to the rest of the world and print additional money. But everybody's doing both of those things. So, and including some places that are going way beyond what we're doing in terms of interest rates. So that's not very helpful. And tariffs, if you make trade agreements, which have been made for decades now, that say or get rid of tariffs, that could help international trade. And that's sort of one area where maybe the administration will take action to lift tariffs that they've imposed in various countries in the hope of helping to generate additional economic activity on a global basis. But that remains to be seen, and it's unlikely. So the idea here is that international trade is not going to be a driver to take us out of this particular economic ditch. The final element, and in this circumstance, what I'll try to convince you of, the most important element in our economy is government. So government has that G portion of GDP and the capability of directly spending money and hiring people during periods of unemployment or underemployment of resources. Our federal government in the United States can run deficits as big and for as long as they choose to. There's no known limit. The idea that we would worry about deficits or debt at a time like this is nonsense, and it should be the last concern of policymakers. The fundamental challenge that we have right now is that with job losses in so many different sectors of the economy, state and local government, federal government employment is critical to the ongoing health of our economy. States are going to be entering into a massive fiscal challenge for the fiscal year that's going to begin on July 1st because of the significant decline in business activity this quarter and the loss of typical revenue sources such as income tax, sales tax, and capital gains taxes. So keep in mind that according to the Bureau of Labor Statistics, we have over 21 million people in our workforce who are employed by federal, state, or local government. It's teachers, it's firefighters, it's police officers, it's social workers, it's our planners and building inspectors in the lot. It's a very important sector. And when we come back tomorrow night, Sunday, we'll talk more about this and what it is we can do.